I mean, even to the extent where people last year were talking about 30% price falls. I mean, that's so irresponsible to say that, given Australia has never seen 30% price falls.
Because there's been a similar issue with industrial. It's one of the reasons they've grown so much in face rent values, because you can't replace the buildings in the same value you once did. And it's obviously very margin sensitive, that industry. So if build costs went up 40%, then sort of the price needs to, or the rents need to in time as well.
I often get asked, like, is now a good time to buy? And it's like, well, yeah, of course, property's a good investment and people have done very well over the long term, but fundamentally, is it a right time to buy for you? Do you have your finances? Can you get a good rate? What's the property you're looking at?
Okay, everyone, how you going? Phil Tarrant here. Welcome to Inside Commercial Property with Rethink Investing. I'm your co-host, and I got quite alarmed when I saw the brief for this particular podcast. 46 episodes. Scott O'Neill, founder of Rethink Investing, 46 episodes we've done through the COVID pandemic, out of the COVID pandemic, and here we are.
I know, I'm shocked that it's that number, but the years are what's scaring me now too. Like, we've been doing it for 3 and a bit years, and time flies when you're having fun. The world's different, business is different. We've both been doing a lot of different things. It's been great. So, see what the next 3 years brings.
Well, it's good to see you got the brief with the white shirt, and I do know, and people are going to be asking what's going on. It's the second time I've seen you over those 3 and a bit years with your arm in a sling. What's happening?
So
you punched out an agent, did you? Didn't get the right price?
You're tempting sometimes.
Yeah.
No, they're all pretty good. But no, the elbow, it's the third surgery now. So they had to put new tendons in the elbow because it was loose the second time. So Don't break elbows. They're very complicated. And but it's meant to go back to 98% of its usual function. So touch wood, if that happens, be very happy, because it's been 2 years of having an average arm. So just to get back normal, that'd be great.
We're quite fortunate that your job isn't on the end of a shovel or something physical. So
you'd be 3 months doing nothing.
Yeah.
That would be a big problem.
So business continues, no changes, or everything's changing.
This is just a rapid year of growth. Like I think we're up to 8 new employees already in the last couple of months. So we've got more coming. It's full on. So lots of HR, lots of inductions, your usual growing pains you've got. But we're seeing that there's going to be a lot more transactions in the commercial world. So there is been about 2 years of limited transactions due to everything that's happened, and we're now seeing the disparity between where the sellers want to sell and the buyers want to buy. That gap is the closest it's been for a long time. So transaction volume should grow quite rapidly, and they're off very low bases, by the way, so it doesn't need to grow much to have a good percentage increase, but we're trying to collect as much of that market as we can, so we're growing the business in line with where we're seeing the market. So this is why we talk about the economy so much, because as a business owner, you need to read it as much as an investor does. So we're getting ahead of it through staffing up, essentially.
Yeah, and I do note, and I've been an observer of your business for quite some time, and we are recording this on International Women's Days. You guys have great representation of female talent inside of real estate, and I know you guys concentrate on that. But I think the industry can do more, personally, around attracting female talent into the industry.
Yeah, we're well over 50% represented by women, and I'd say in commercial particularly, there's very few in there, especially in the sales agent division. It's terribly underrepresented, and it does need to change, because a lot of it's a traditional industry that a lot of people kind of default to, and I don't know why. You look at this residential markets, it's a lot more evenly spread, and there's no reason why it should be the way it is in commercial. So it's changing. You see it. I know the women we've got in our business, they do particularly well, and that's why I'm surprised with the disparity. I have no idea what the stat is, but I'd feel like it'd be less than 1 in 10 sales agents would be female.
Yeah, well, I think the sector can do better, but if we're chatting about it, at least we're on the way and the pathway for doing it. But quite serendipitous today, because we have one of the most senior female operators in real estate joining us, Nerida Conisbee. She's the Chief Economist over at Ray White Group. I've known Nerida for a number of different years, a number of different roles for a number of years, most previously with REA. Nerida, how you going? Welcome to the show.
Yeah, thanks for having me.
Now, I thought you were a residential property person, but it's become clear to me that you're more commercial. Your background is in commercial. That's where you come up through the ranks as an economist around commercial property, and you pivoted into residential. So that was nice to know.
Yeah, it's been an interesting journey. I started as an economist working with a company called Jeb Holland Damasi, and we did a lot of I built forecasting models for customers like Westfield and Lendlease, all the listed property groups, and so started there, then moved into agency and now residential. But yeah, about 20 years in commercial property. So it was certainly where I learned a lot about property, and Andy's also a passion of mine. I love watching what's happening, and also I feel like I know everyone in commercial property as well. Yeah. So it does feel a bit like family at times.
Am I allowed to ask you what you prefer more, residential or commercial?
I like both. I mean, residential is interesting because it does affect everyone, and everyone's got a view, and it's fast moving. I think that's from a data perspective. There's always a lot of data, and there's a lot happening. And you look at Perth and you look at Melbourne. Things are quite different. Commercial though is far more complicated. It's the sectors are very diverse. I mean, if you compare an office building to a childcare centre to even like a build to rent project, they're all very different. So from that perspective, I do find it quite fascinating, but it moves a bit slower. So I can kind of step in and out a lot more in that sector compared to residential, where you miss 1 week and suddenly things have changed quite significantly.
Yeah, and it'd be remiss of me not to ask you, while we have someone like yourself who has such a exemplar career inside of real estate, we have a lot of female listeners to the podcast who are all trying to make a few bucks and create wealth through property. But what I see, and Scott sees quite a lot as well, is that a lot of people pivot from property being a wealth creation project into a career. What's some really good tips for females to make a mark in commercial real estate, to move up through the ranks?
Yeah, I guess I mean, we've been talking a lot about representation of women in commercial property, but it is changing. I mean, if I have a look back, sort of 25 years ago, there was very few women, and we're starting to see that really changing. So I think one of the things that has changed is that people are required to be more educated coming into the sector. So a lot more women studying property at university, a lot more valuers. A lot of women moving into commercial property do come through the valuation stream. So being good with numbers or understanding numbers is really important. So I think that education component is important. Also, even if we have a look at a lot of the listed companies now have a very big focus on trying to ensure more representation of women. The agencies as well, but they tend to be a little bit slower moving, but definitely the listed space. So, there are lots of avenues into it, but I think always the easiest way is to, get educated, get to know people and move in through that way.
Yeah, my view of it all is I think the intent is there, but it needs to be, and I think there's a responsibility of a lot of the big listed players, superannuation funds and sort of connected agencies that support commercial growth to structurally promote and support change and get behind it, because we need more females in the workplace, particularly in commercial property.
Yeah, and I'll probably just do a shout out to the Property Council, because I think they, in terms of my profile, they did a lot to really push me early on. They introduced a panel pledge to all of their events, and so I went from like being at the events and just always watching the same people to being invited to speak, and that really changed the trajectory of my career. So I think groups like the Property Council have been for commercial have been really important in ensuring and better representation.
Well, now you're relied upon by a lot of people to support decision making with your insights around economic predictions and the way in which Australia is evolving and changing, and how that sort of interfaces with property. Do you sort of the weight of that responsibility sometimes? You ever sort of connect with it, saying what you say and think and communicate can change what people do?
I do, because I think it's particularly, commercial property is a little bit different because people do tend to be in the industry and across what's happening a little bit more. When we look at residential, though, there's, even to the extent where people last year were talking about 30% price falls. That's so irresponsible to say that, given Australia has never seen 30% price falls, and not specifying where. I think when people hear that, they do get quite panicky and worried. So,
The question I was going to ask you, sorry,
Yeah.
on that, those 30% price falls, a lot of them come out of the bank's economic departments. Do you think there's any kind of motive or it just seems kind of quite creative that they come up with these massive predictions and they almost go the other way. Is there any sort of, I guess, angles, there from an economic point of view or even a sales division point of view?
That would be terribly irresponsible, but I hope not. I think it's more sort of headline grabbing. I think, if you come out and say 30% price fall, the media will immediately pick up on that and publish it. So, I think too, there's a lack of understanding around property markets, commercial obviously because it's difficult to understand, but residential because people will look at interest rates and think there's this, one-to-one link between what happens to interest rates, but, ignore the fact that Australia is growing and construction costs have blown out and, we've had rental growth, which has never been seen, the highest rental growth we've ever seen. So, there's been such major change and such pressure on pricing, which I think a lot of these forecasters really ignore.
Yeah. We've been getting a hard time over the last sort of 3 years. I think we've called it pretto well. We haven't been caught up in the noise and the idiocy sometimes around predictions around price growth. But the point is that a lot of people rely on information to make decisions around investing, and there's still this hangover of, and I still hear it every day, of everyone saying, well, we were told interest rates weren't supposed to go up to 2024 and therefore we made decisions based on that premise. So there is a responsibility and accountability from economists, but knowing what I know and knowing quite a lot of economists, senior economists, is that there's no bias or agenda. They try and get it right, but there's a lot of things out of their controls and they can't telegraph the future sometimes.
Yeah, and that interest rate call was a hard one too because the Reserve Bank themselves were saying that they didn't expect rates to rise and their view wasn't inconsistent with global views of different banks, so of different central banks. So, yeah, that was probably one of the worst. Yeah,
it'll go down in history as a real clanger. But so what we've got you, Nerida, I'm conscious of time and I reckon we're going to end up sort of debriefing after this podcast saying, we should have asked about this and the other. So if we miss stuff, we apologise, but you can send all your questions. We can probably get follow-up, Scott. You can do it through the Rethink Facebook page, and we'll put some details in the show notes. But what we've got, you want to chat about inflation today. You want to chat about interest rates, obviously property prices, and we want you to sort of telegraph the future for us when it comes to commercial property. But inflation, it's probably on the downward cycle of running it through this heightened period, getting it under control. What's your views?
Yeah, it's definitely coming down. Monthly inflation was at 3.4% for January, so Reserve Bank are trying to get to between 2 and 3%. So we're getting there. The big one, of course, has been construction costs are starting to come back. That was such a problem. All those block supply chains have become unblocked, so that's a big one. I think one of the challenging aspects of inflation has been the rental growth that we've seen, and rents do feed into inflation. It's been a big component of the growth in the CPI, and one of the problems we have with it is that the reason rents have increased is that there's not enough homes being built, and increasing interest rates make fewer homes being built. So there's been a bit of a circular problem with what's been happening to inflation, but definitely coming under control. It's a very different outlook compared to where we were at the end of last year. Once that November rate rise came in, there was a view that rates would probably go up again because inflation wasn't coming down quick enough. But by the time we hit December, we started to see a much greater improvement in conditions. And
what are we seeing with the current construction costs? Why do you think that was lagging? So much higher, in terms of sort of the other indicators out there, because it's still quite high, isn't it?
Hasn't come back.
Yeah,
it's been terrible. It's been such a shock, and that was just a combination of factors. So, in 2022, the cost of building a new home, which is what CPI tracks, jumped 20%. So we saw a jump of 20% in construction costs, but even worse in Queensland, it jumped 30%. Places like Perth, we saw much higher increases. So, and it's just a combination of factors. It was materials. So we had a shortage of materials. We had a shortage of labour. So a lot of labour, particularly foreign labour, when went back overseas during the pandemic. So that was a problem, trying to get that labour back in. And then there was productivity problems, because if you consider on a building site, if you're putting in a bathroom and the bath doesn't arrive, then the timing of your project blows out from 1 week to 3 months while you're waiting for the bathroom. So there was this lag in a lot of projects that hadn't wouldn't have occurred if the supply chains were unblocked. Yeah, and then the company's going bust. So, that was, again, we started to see a lot of companies go under because costs had gone up and they were on fixed price contracts. So it was this really terrible situation.
Because there's been a similar issue with industrial, because one of the reasons they've grown so much in face rent values and even just construction costs have really pushed those up, because you can't replace the buildings at the same value you once did. And it's obviously very margin sensitive, that industry. So if build costs went up 40%, then sort of the price needs to, or the rents need to in time as well. So yeah, that's what we've been hearing from developers on the ground. They just can't make ends meet. And over the last few years, there's been a lack of supply, even though the market's got quite strong from a tenant point of view. So I guess that's a question. Where do you see the industrial side of things going on in the next few years, now that rents, they're still growing at, I think I checked, 10.8% annualized right now as of quarter one in 2024. So it's still growing quick. So do you see that kind of starting to cool down at some point?
Yeah, I mean, industrial's a fascinating one because, early on in my career it was kind of the low growth one. It was a high yield. Everyone was very private investor. We didn't have much institutional investment, but that's changed. I think in terms of growth, it's still the darling of commercial property. It's still, if you look at the MSCI data on total returns, it is still seeing positive returns, where if you look at office and retail, it's, in negative, depending on what sort of where you are and what sector part of the market you're looking. But, fundamentally industrial is the asset class of the future, that so much of what we need needs warehousing, and we're shopping online more than we ever used to. Grocery shopping has been sort of the sticking point for online retailing, but that's increasingly going to go online like it has elsewhere around the world. So that's one component. If you have a look at driverless cars, if they ever emerge, they're going to have to park somewhere. You look at food manufacturing, that needs warehousing. And then what we were talking about before around construction costs, that one of the challenges we have for all sorts of property, and applies to industrial, applies to residential, and many other asset classes, is that the cost of replacement now is so much higher, and so that does force up the values of existing facilities, and we're seeing that absolutely in industrial, and we're definitely seeing it in residential as well.
Yeah, interesting.
When do you think the conversation around inflation is going to be normalised and we won't be talking about it anymore?
End of the year, for sure. If it's sitting at 3.4% in January and it starts to get below 3% in the next few months, I think at that point it will be a non, it will be something we don't talk about. I mean, we never used to really talk about inflation.
No, but it's become, rather than talking about property at dinner parties now, you talk about inflation. So it'll have to come normalised at some point, and that will cascade into what happens with interest rates. But before we get to interest rates, can you give me a sense for the global shocks that are happening at the moment? There's seismic actions happening outside of our borders, and the implications around commercial property. And everyone's sort of familiar now. The war in Ukraine has dragged on 2 years, and that will continue for quite some time. You have Houthi rebels disrupting the Red Sea, and shipping costs are getting expensive. How much does that actually impact Australia when it comes to commercial property?
Yeah, it has varying impacts. I mean, Ukraine has been interesting in that Ukraine is a big producer of wheat and food. So that's had an impact on global. I mean, I'll talk about wheat because it's such a big component of Australian agricultural production, but that really forced up the price of wheat last year. And we produce a lot of wheat. It's a big component. And also last year we produced a much more wheat than we normally did because our weather was so good. So we did, as a country, and many state economies did really well last year because of Ukraine and the fact that wheat prices went up. In terms of the war, obviously shipping costs is a big one. I mean, it's not so bad as COVID blockages, but it does have an impact. It definitely impacts oil prices. So oil prices at the moment, they fluctuate such a lot, but a lot of the increases that we've seen have been because OPEC have said, okay, we're restricting production. We don't want prices to fall, so we're going to make it expensive. And then you have other parts of some of the countries in OPEC going against that. So then they flood the market with oil. And so, that has an impact, makes it cheaper again. So, there's a lot that we really can't predict in terms of behaviour of certain countries. So definitely oil prices, definitely food production, it influences. And then I guess the disruption that we're seeing everywhere, it does impact confidence as well. I mean, I think Australia, we're so lucky because we're so isolated in many ways, and the economy is linked globally, but from a lot of the turmoil that's being experienced, we're not impacted as much as, say, Europe with their gas crisis and their fear of what's happening with Russia. We're not as impacted as those areas. So
to put all of this in a perspective, we operate in around real estate and talk about this stuff all the time. So you think that it's really important right now. It's maybe more heightened than what it has been before. This cycle that we're currently in, with shocks influencing inflation or the drivers of economic growth here or accessibility to products or services here, you've got these things happening all the time. Is this just normal? Can you give us some perspective to it? Is it normal and just get used to it? There's always going to be something that changes stuff.
Yeah, absolutely. And I think this is the advice to investors is that, there's just stuff you can't control. And fundamentally, you do need to be aware of risk and you do need to consider your personal circumstances. And this is a question that I often get asked, like, is now a good time to buy? And it's like, well, yeah, of course, property's a good investment and people have done very well over the long term, but fundamentally, is it a right time to buy for you? Do you have your finances in order? Can you get a good rate? What's the property you're looking at? And most of the time, that is more important than actually when you buy. And I think this is, coming back to a lot of the media that comes out around house prices and, that people do put off decisions based on what comes out in the media. And I think with property, the best advice generally is just to get in as soon as you can, because we know that Australia is growing. We know there's going to be demand for housing. We know there's going to be demand for industrial property and commercial property over time. So, really trying to just get into the market is the best thing.
I'm really happy you framed it that way, because the cynic would say economists are just there for coming up with the next thing that drives media headlines. So it's good to see a nice considered approach to the practicality of property investing. And one of the reasons why myself and Scott joined forces with this podcast is to try and shape some sensibility around decision making with property investment. And my view, and Scott's views no doubt, is if you can afford to invest in property, now is always the right time to invest in property. So it's good to see there's a cohesive sentiment towards sensibility around property investing.
Yeah, exactly. And like you said, Nerida, a lot of these are just headline grabs from small parts of these reports you guys make, and then like the high level numbers, and that's what gets thrown through the mainstream. And you're right; these decisions are made on, like, I know there can be a current affairs story, and the next day our demand drops off. Depending, like, it has that much of an impact. More residential. You can actually
map that, can you? You actually see it just.
More in our early days when we were more residential sensitive focused, but it generally has quite a major impact on confidence. Like, if there's a major media headline saying there's a crash coming, you can lose contracts on the day, like based on a third party decision maker like that. But and especially all these inflation figures in the recent times, there's been a lot of people I remember that period where it started to look like it was coming down a bit and then it went up again. Investor, and this is even in commercial, the confidence cooled in that period. But I've always been of the opinion, like, high inflation long term is kind of a good thing for commercial investors, because it's almost, it's going to push rents up, means less supply. It's going to give you a kind of a better picture long term. Like, I think low inflation for long periods of time is not good for capital growth, is it?
Yeah, well, I suppose too that if the Reserve Bank are cutting interest rates, it means the economy is cooling too much. So we saw GDP figures come out last week, and it was low. It was 0.2%. So we're not heading into a recession it doesn't look like we're heading to recession anytime soon. But fundamentally, if they need to cut rates, it means they're trying to generate activity. So there's always that flip side to it.
Yeah. So let's chat about rates. But beforehand, Scott, you spoke about investor confidence, commercial investor confidence, and maybe they don't get their jitters as much as what resi investors do, largely because they're a bit more sophisticated. They've probably been around property a little bit longer, and they've got the experience investing through resi property before they transition. But give me a gauge for commercial confidence right here, right now. Is it positive or negative from a sort of central line?
From dealing with our clients currently, it's as high as I've seen it since pre-interest rate rises. So,
okay.
And that's why we're, like I mentioned before, we're staffing up at the moment. We're seeing the gap between where the sellers are in terms of yield and the buyers are. That's the closest it's been. So there is deals happening. There's the talk of the interest rate drop whenever that is. It almost doesn't matter. It's just the talk of it, which is getting people excited. Gives you the impression there's a window of an opportunity of best buying conditions, because you don't want to buy after the rates have dropped, because naturally sellers will increase their expectations on price like that day. So if you get in early, cop the higher interest rates for a period of time, you theoretically should get a better deal. So the sophisticated guys think like that, and we're seeing our transactions are increasing. We've got even just from a company point of view, 2.5 times the sign-ups per week. These are new clients, and they're, on average take about 3 to 6 months to settle on a property. So, we're seeing a window up to 6 months into the future with these guys. And, as I said, it's about 2 to 2.5 times the volume of new clients compared to the same time last year. So it's definitely busier.
And with that balance with what you're seeing, forward forecasts and having a finger on the pulse, kind of like the ground truth meets the numbers and insights.
Yeah, I mean, it's a little bit harder with commercial because it's so diverse, but definitely last year seemed to be the worst. And in terms of sentiment and even in terms of performance, I think even sectors that were pretty strong from a tenant demand perspective weren't doing that well from a value perspective because there was a lot of negativity around. So I do think last year was probably the worst. I think now people are seeing what the impact of COVID has been. Commercial was a bit delayed. I think that's the other issue, that residential was quite quick. We could see the impact on values. We could see what was happening with rents. With commercial, a lot of the rents are locked in for 3, 5, even 10 years, and so those rents were tenants were continuing to pay rents even though they may not have decided to occupy the building once that lease was up for renewal. So it did take a little bit longer, but it does seem that last year was seen as the worst.
I remember seeing a report from Ray White showing the total transaction volumes, and I thought it was a typo. Like, it was down over 70% from the 2021 peak. Like, it's unbelievable how quiet the industry got after that peak.
It was, yes. So that data is from Real Capital Analytics. So they track every single sale that's undertaken, and it's quite shocking. It's shocking to see that chart because it really flew up during the pandemic, that commercial property transactions skyrocketed, and it was, this is a thing too with property. We saw it in commercial and we saw it in residential, is that one of the things that does hold up values is that people hold on during bad times, that people are better educated now. They don't panic sell like they used to. And I think that's really apparent, that particularly for resi, that, you can quite quickly see when people are panic selling, but people haven't, and they are now more conscious that the bad times get better, and to hold property is a better idea than to try and transact and get out and then try and get back in again.
Yeah, and that's one of the great arguments when someone says, it's going to drop 30%, especially in commercial. Chances are the guy or girl has a 50% plus deposit in the asset, because you need to go minimum 30% down and then maybe a couple of years of growth on it. You're well over the 50% cash mark. There's no reason just to quickly drop the price and sell. Their cash flow is probably better. You just hold through these periods, and that's exactly why that transaction volume was 70% down, because people just don't need to sell.
Absolutely. It's funny too, looking at who was buying and selling last year, that I don't know if we'll be talking about this later, but talking about the privates and how active they were last year, that they were the net buyers of commercial property, which during the pandemic they were net sellers. And we do see that every cycle, that because privates can make decisions a lot quicker, they do tend to swoop in during times of price drops because they can see the opportunity. They don't have investment committees they have to go through and the like the listed groups. So last year, the people who were selling were the listed groups. They were under pressure from shareholders and their boards to make decisions and move quickly. And they're the ones that, I'm sure they're well run. They're obviously well run companies, but, they're the ones that transacted and the privates are the ones that really took the opportunity to buy stock last year.
One thing I've noticed through this last period and sort of a sense towards the confidence level is the sort of notion is heightened more than ever before that not all asset classes are created equal. And you see this divergence in prices for resi houses versus units is just growing. And you see the same inside of commercial with industrial versus, say, offices. Do you think we're going to get back to some more similarity between asset classes, houses, units and industrial, office and retail coming closer together? Or do you reckon this is going to be a structural shift that's going to remain?
Well, I guess the houses unit one is clearly around land value. That in the end, land is where the value is held. So if you've got a block of land with one house on it versus a block of land with 20 apartments, and one apartment is probably not going to increase as much as that one house. So the house and unit one is interesting though, because if you have a look at a house, I always use the example, a house and an apartment within one suburb, the house will do better. But if you have a look at an apartment in, say, Mossman, and you compare it to a house in, I don't want to pick on any one suburb, but just say Blacktown, the apartment in Mossman is probably going to do better than the house in Blacktown. So there are differences, and so I think that's probably the other thing that you have to look at when you are investing, that units in many urban areas do quite well and are a worthwhile investment. With commercial, though, it's definitely structural. If I think over my career back, when I started, shopping centres were like totally, they were seen as, people use terms like fortress-style investments, that they were such good investments, and there was no gloom in the horizon because there was population growth in Australia and retail spending kept growing. Sometimes it dropped off, but then it came back again, and there was all these things around shopping that no one expected to change, and then online shopping came on and that did change. So that really changed the conditions. Industrial, industrial has changed so much that, the industrial agents 20 years ago are so different to the industrial agents now that, they have to be far more sophisticated. They're dealing with institutional investors now. They're not just, the deals are becoming more complicated. The tenant requirements are becoming more complicated. So industrial's really changed. And then office. It was interesting. I did a presentation, I think it was the day after lockdown. I was presenting an event, and so I had my slide pack, and I was like, it was on commercial. I was like, oh damn, like everything's changed. I had to, scramble around thinking, well, what does this mean? And commercial, that was the one I just didn't predict, because I thought people would be back in the office within a few weeks, and then obviously we didn't go back into the office for quite some time, and it had such a fundamental impact. And office was really seen as a very stable, very safe asset class, but that's really changed with what's happened during the pandemic.
Yeah, so we're recording this podcast in Sydney, and when I come here in a taxi today, sort of reflecting in hindsight, I was looking around and I didn't really get it until I've just thought about it now. It was really a microcosm of real estate and the economy in Australia. At the top end, you've got big development with the new the metros. There was buildings with scaffolding all around the commercial properties, which retail and office. There was a lot of hotel developments, and as come further down, got a bit humdrum, and there was a lot of empty places, and it looked like no one wanted to be there. And to me, it was just reflective of the economy meets government and infrastructure spending decisions meets habits and behaviours around commercial property investing until we get to where we are now, which was, again, quite nice. And it just got me thinking the mechanism of interest rates is a driving force for most property decision-making, both at an instate level but at a private level. So everyone's sort of hanging on the end of their seats right now thinking, when are interest rates going to start coming down? Because that will be a catalyst for changing sentiment, changing growth and access to money and capability to invest in property. are we going to be able to get you to tell us exactly when interest rates are going to start coming down?
So I mean, there's many ways you can forecast interest rates. You can kind of just make a call, or I reckon it'll be May or, whatever. You can build a model. And, I've spent a lot of my career building models, so I know how sensitive they are to particular assumptions. So you can build a model, or alternatively, which is my preferred method, is looking at the ASX interest rate futures index. And I think that is good because people actually have money invested in where that futures index goes. So they're actually putting money down on where they expect interest rates. And I think that's, when you've got skin in the game, that does change your view and your behaviour quite significantly.
I was actually following the ASX futures just in the last lead up. They were predicting a 16% chance of a cut in the March quarter, and then it dropped down a few days down to 5%. And I don't know what it is today, but you can see how much it really flows depending on the variables of the day.
Yeah, and that's it. It's a daily look. You can run your models daily, but you're still using the same data in most cases. But this does give you a daily
live
look.
Feed.
Yeah, it's a live feed. So I'd look at it closely. But at the moment, that's saying I think a cut in sort of around July, another cut sort of before the end of the year, and then a third cut early next year. So that's the market now. It could change. I mean, we know how quickly it can change. I mean, if you look again, going back to December, it was, that rate hike in November, everyone was thinking, oh, there'll be another one in February. We had people saying, yeah, that for sure is going to happen. And then February went by and we're talking about cuts at this point. So, yeah, I think we will, so my view is we will see cuts this year. And even if inflation doesn't get below 3%, I'm sitting at 3.4%, so it probably will get below 3%. But given the economy is barely growing at this point, the Reserve Bank do need to move because it takes a while for those cuts to flow through. So they don't want to leave it too late and push us into recession.
Okay. So when?
I think the earliest
does the sort of corporate say, don't be too specific.
No.
You're diverted to the ASX.
No, they don't pull me up at all.
No,
so, I mean,
go for it, right?
It's a nice place to be. But the earliest I think they'll go is May. And the reason being is that monthly inflation is coming at 3.4%, but that doesn't use all the data. And the next time we get quarterly inflation will be late April. The next board meeting will be May after that. So if that is down 3% or below, I think at that point they'll make a cut. So I think it's May the earliest.
And the Aussies popping champagne corks thinking, here we go. What do you think, Scott?
I hope it's not that early.
Okay.
Just
interesting.
It's just the reason, it's going to, I guess I run a buyer's agency business. We want to be buying well for longer periods of time. It will push prices up, at least from the vendor expectation point of view as well. They'll see it. And, I saw a video that Tom Panos did, who we both know quite well. And he said he was in an auction and there was 13 auctions he did. And 3 of them, the vendors, because of all the talk, all this chatter about interest rate drops, they actually raised the reserve on the day for no reason other than that chatter. So I fear that'll happen with commercial property because any excuse to ask for more money, it's a good excuse. Let's do it. Yeah. So May's soon. That's I was hoping a longer window. So
you say, so on that basis then, if it is May,
have
you missed it as in this purple patch for buying commercial property?
No, because a lot of the vendors weren't meeting the price anyway because the volumes are down. So they've come down more this year. So there's more link-ups with sales and transaction volume. So the value is there for the investors more than it was late last year. I think, my prediction is it'll be a bit later than May just because I'm not like Nerida, looking at the stats every day, but it just feels so soon. And I know, it's the market is I don't know, it's almost like it'll cause more problems potentially, at least from my space with, the rents and people paying more from a property point of view. But I'm not following, what OPEC's doing and, how long it takes to transport something out of China or Europe. So, they're all the inflation side I've got no idea about. But from a property point of view, it's going to be putting more upward pressure on prices and rents aren't slowing down anyway. So we're going to be in this environment of high growth for both values and rent. And they're not building enough as well. So it's a long-term problem. it's it's going to be a period of time which most values will go up, and if they push rates down, it's literally going to speed the problem up.
Yeah, and we're going to move into a cycle probably relatively unique. A lot of Australian investors or the average Aussie on the street will probably think it's halcyon days for banks sort of making record profits because interest rates are so high. But I'm speaking to a lot of banks, senior people in banks, and they're crying poor already around the cost of funds. And I don't think banks are going to be quick to pass on interest rate savings to Australians. Do you have a view on that, Nerida?
Oh, I'm sure they'd like not to,
yeah.
but I think there'll be a lot of pressure on them to do that.
We're starting it now, sort of anytime I get a chance to give it. But
they were very quick to pass on the increases, so I think it would be seen as a bit unfair if they didn't pass on the cuts.
Yeah, and I think they'll get a lot of pressure from government also because you're going to get this intersection of a decreasing rate environment nearing and coming up to a federal election. So I would imagine there'll be a lot of weight placed on lenders to pass it on, whether or not they'll do it at the same speed as the cuts. But we'll have some fun talking about it. And that'll have a catalyst for how people's attitudes and sentiments towards commercial property evolves, whether or not they can access debt and whether or not that debt is at a level which meets prices. It probably takes us to a bit of a discussion around property prices. As rates start coming down, do you see rapid price growth is driven by increased demand and turnover, or give me a sense for that supply and demand equation?
Yeah, so I guess, maybe I'll start with resi and then we'll talk commercial. I mean, resi, we saw last year prices increased by 10%, and that was in a rapidly rising interest rate environment. So this year, we've got, under similar conditions, we still have a shortage of housing. We've still got construction problems. Population growth will slow a bit, but that's, that may have a bit of a leavening effect. But fundamentally, we'll probably see, if we see rate cuts, we'll probably see prices grow by more than 10%. I mean, if we have a look at the start of this year, I mean, we're only 2 months in, so it's a little bit, a simple extrapolation of 2 months into the full year would give us price growth of about 15%. So, I wouldn't be surprised if resi prices increase by more than 10%. I think for commercial, it will depend on the sector. And if you have a look at office, it will probably stabilise things a little bit. I mean, prices have been coming back a lot, and there's low levels of transactions taking place. I think industrial is quite different because the tenant demand situation is so strong. So that combined with lower rates will push up pricing quite a bit.
So talking about the office market, there seems to be a lot of development around office, and there's a big investment. So our offices are in North Sydney. There's offices going up all over the place. So there's this sort of centric view of most investors stay away from office-based investing because the demand isn't there. We're still trying to rationalise what the world of work looks like into the future with work from home, and the government now, there's discussion around mandating it, that it's you have to provide that as a right of the Australian worker, which is going to be very polarising. Why are people building so many commercial office towers when office market's on the nose? Can you explain it?
Yeah, I guess it's the pipeline. These projects take a long time. The lead up so long, and so a lot of these were really planned before the pandemic. So that's part of the problem, that they're just long-term projects that take a long time to get up out of the ground. So that's a big one. Also, the other issue is around, if you look at CBD office, the performance of that's quite different to, say, the performance of suburban office, and then different again to regional office. And not all office markets are doing badly. If you have a look at somewhere like the Gold Coast, the office markets are really strong. So any regional area where you've seen a lot of population growth, they're doing quite well in terms of their performance. CBD, the problem now is, as you said, high levels of construction taking place, people not wanting to come into the office. And also government is a problem because government is a really big occupier of office space, and they're not requiring their staff to come in. So, it is a battleground issue because people quite like working from home, and, there's a lot of challenges trying to get people back.
I still don't know how it's going to play out when
I don't know
when the government isn't incentivising its own workforce, and the government, it's a bit of a catch-all, right? For local, state, and federal, and this is not a beat up on government, but they were quick to say small businesses suffering because these micro economies, whether it's big CBDs or or satellite CBDs are struggling because there's no workers in the office, and therefore it's stifling local economies. Dry cleaners, coffee shops, restaurants, all and sundry, which has ramifications for commercial property investors as well, because that's probably where a lot of your clients would operate. Maybe sort of they're not buying the big institutional blocks. They're probably the peripheral assets that sit in and around it. It's a huge structural issue I think Australia has right now, and it gives no certainty for anyone around the office market moving forward. And on that basis, I'm not touching office side until it works its way out, and I think it's going to take some time. And no doubt that's recommendations you're giving to your clients.
Yes and no.
See, it's a loaded question.
Yeah,
wasn't
that's a loaded, because I like what Nerida said. She mentioned it's not all equal. So even the CBD office market, like one of the best ones right now is Brisbane. So prime office buildings in Brisbane, their vacancy rate's less than 6%. Compared that to one of the worst markets in the country, which would be Melbourne secondary assets. That's sitting at about 19% vacancy. So
we had a question recently from someone specifically around this, around commercial, the implications, the impact of Brisbane commercial property, particularly with looking forward to the Olympics coming in.
Brisbane's quite strong, and the rents in the last 12 months have grown 11% for prime buildings in Brisbane. So that's a really good equation for anyone that bought a building 12 months ago. And with all the, population growth and the Olympic Games coming up, and the fact that people may end up back into the office, or the, immigration levels, or net migration levels overseas, like this, maybe it's a counter-cyclical play in some areas. So I like watching the vacancy rates quite closely. Like, I wouldn't touch most of the CBD markets just due to the massively higher vacancy rates, but those tighter ones, like, that's almost, you can start calling the bottom in that. And you're getting, especially from a historic point of view, probably the best per square metre versus industrial versus retail that you've ever had, because office used to be the darling, not industrial, and no saying it's going to stay like that forever. So yeah, I agree with you, Phil. I probably wouldn't buy most properties that have office in it, but regional office, it's, they've got the best fit outs and tend to have the best tenants. So I wouldn't just go, I'd rather an empty shed for the same money, like when you've got a great tenant and a higher spec fit out next door to it. Like, you still got to look at that case by case.
And so we're talking about what's going to happen with property prices. I don't know if you ever do this, because I got a large-ish property portfolio, and whenever I get frustrated with property or get annoyed with it, or I'm sick of paying interest rates and stuff, I got to sit there and put it into a capital growth calculator, and I sort of put it all in, and I press a couple of buttons and I play around with 5%. It's good to hear that resi property, I've got a lot of resi, is going to keep growing. It sort of realigns and reconnects me with all the reasons why property is such a good asset class, and the growing sort of disparity between your interest rates and the growth in your asset and what you can do with that in time, right? So every single property investor is concerned about capital growth and prices. So you spoke about resi, and I sort of concur with a lot of your sentiments there, and I think not all resi property and locations are created equal, so be careful where you do invest. But we spoke very briefly about office markets there. Can you give me a sense for price growth in and what you're seeing, and maybe you can come up with a couple of different areas around specifically industrial, because I think that's where the main game is, and what's happening at retail?
With retail as well,
yeah.
Shopping centres. Yeah, so retail, I mean, again, coming back to everything, every asset's different and every location's different. Shopping online obviously is the future, and we are shopping more online. Retail's changing. The thing with retail, though, is, again, a location can really change the outlook. And if you have a look somewhere where you're seeing a lot of population growth, and it doesn't have to be an urban fringe population growth area, but if you suddenly put up, if you have a look at some of the transit-oriented development that the government's trying to put through, if you put an extra 500 residents into quite a small area, that dramatically changes the outlook for that retail precinct around there. So I think if you are looking at retail, looking at what the future changes are to population growth is really important. Changes to the demographic profile. If you've got an ageing population, you start to get a lot of younger people in, so that urban regeneration can rapidly change the outlook for a retail shopping strip as well. So there is a lot to consider. And then also, if if you're coming back to southeast Queensland, I mean, that area is booming at the moment. There's so much population growth. It's the highest level of interstate and international migration ever recorded for that part of Australia. So adding that many people into a whole region of a state is dramatically changing the amount of retail spending. And we can really see it in the restaurants that are being built in places like Brisbane, that Brisbane restaurant scene has exploded because there's all these people with all their money, and it's people are just spending more, and that really changes the outlook.
And industrial?
Well, industrial is, coming back to what we spoke about earlier, is around the changes to how much we require more industrial property, and we're not building. We are. The cost of building is increasing, but the land, just land runs out, so you just got to keep pushing out, and so that does just increase the cost of industrial, and then you've got encroaching residential development. So if you have a look at a lot of industrial areas close to the cities, they're changing too now, and they're becoming more valuable because they're the changes that are taking place. I live on the northern beaches in Sydney, so if you have a look at somewhere like Brookvale, which was very much a cabinet makers and panel beaters and sort of traditional retail.
Now it's just bars.
It's just bars, yeah. So
breweries.
You've just got breweries, and you've now got restaurants, and now they're changing the zoning. So if you had bought there 20 years ago, you probably wouldn't have paid much, but if you're on a site where they've decided, you can build a 20-storey residential development, that rapidly changes the value of your
And Brookvale's a really good case in point. So I want to sort of ask you, which markets will perform and which markets won't perform. And so I know Brookvale quite well. How do you find the next Brookvale?
Yeah, how do you find it? I think it's a lot around any of those inner urban industrial areas. I mean, it happened in Fitzroy, it happened in Port Melbourne, Collingwood is another one. They were just old industrial areas. You couldn't get big trucks up and down them very easily. They were surrounded by quite expensive residential already, so that kind of changes the outlook as well. But any of those old style industrial areas I think are definitely worth a look, and particularly for private investors, because you can get in at it's hard for your average private investor to get in and buy an Amazon warehouse 60, 70,000 square metres, but you could potentially buy panel beaters in an area that may undergo urban regeneration. So, so I think that's definitely a consideration.
Well, you have having a sense of some of your clients. They own Bunnings type places, and they get to reasonable sort of size and scale assets, right? It's not at the sort of institutional level, but is there a big appetite for that sort of stuff, and is that what they're chasing? Do you think?
Yeah, no, land is one of the key decision points. Like I was on the phone to a client last night. We're looking at a 18,000 square metre land shopping centre. It had about 4,000 or 5,000 square metres of building area on it, so about 25% site coverage. And one of their key decisions was, we're going to pass this on to our kids. So maybe in 50 years' time or 30 or 10, you could rezone, or you could build up on it or increase the floor area. Like, it's a genuine development opportunity. But we're getting 7% net return day to day on it too. So, yes, it's definitely land orientated, and generally that's why industrial is quite popular, because you're getting more bang for buck. It's cheapest asset class per square metre. Like, office is the most expensive, retail in between. So, it's very important to have land, I think, with a long-term approach.
And most people are still using debt to fund commercial assets. I sat down with my banker the other week, and I was talking about financing for commercial assets, and they really like industrial at the moment. But I got a sense that they thought sort of suburban strip malls and that sort of stuff they want to stay well away from it. Access to funding is going to be key moving to this next market.
Yeah, look, it's different types of assets. Again, like Nerida said, they're all going to have different risk profiles. So when you've got the supermarket, which might have a medical centre on it, it might have a gym, might have, a bunch of restaurants on it, that is still a popular investment with a great long-term approach. Often they've been shopping centres owned for 50 years. They've been there since 1950 and it's been rebuilt once or twice in that time. Chances are it'll be a shopping centre in 50 years' time, just have different types of businesses. As technology changes and consumer demand changes, there's still a need to go somewhere. Like, you're not just going to sit in a house and order things online. that'd be awfully boring way to live. Like you may as well just put some goggles on and live in a different reality.
That's what they're trying to sell us at the moment. I don't know can't remember what they're called these.
Yeah.
You live in a bubble these days, which I find quite concerning and alarming. But do you ever read, Nerida, on access to funding or innovation in funding for commercial lending moving forward? Because I know we've been getting a lot of questions around this. There's a big question mark for a lot of people. Can they get access it? Is there going to be new funding from different areas?
Yeah, absolutely. I mean, non-bank lenders are the growth areas for commercial lending. I mean, if you have a look at the banks or Australian banks' exposure to commercial property, it's quite low now. It's probably only about 5% of their debt book. It's quite different to what we're seeing globally, where I think the US it's kind of 11 or 12%. So
I think that's the case. I was thinking about this myself.
I don't know. I mean, it's been interesting. I mean, it has been to do with the growth of non-bank lenders. So I think there was a period of time where the big four started to feel that commercial was a bit tricky, it was a bit complicated. It was easier to do residential lending. It was more assured.
Probably more assured.
Yeah. So the debt, I mean, if you're someone assessing someone to lend to, and they've got a house versus an industrial building, it's really hard. They do need a lot of specialists in there, and we have seen a lot of the specialists move out of the big four and move to the non-bank lenders. So, I think that talent has really been going across for quite some time as well. So the talent from the banks that, the people that really had a lot of knowledge around commercial property, a lot of them are working for the non-bank lenders. And then the non-bank lenders have really grown because providing debt is profitable. If you were providing debt, you can get a really decent return and a much better return than, perhaps some other, much safer. I think it's generally seen by a lot of the non-bank lenders, that debt is a pretty safe way to use money, and so that's really grown that opportunity.
And they're sort of accessing global dough in order to bring that into Australia to lend out to Australian real estate, so you get an exposure of international.
Yeah. I mean, they all do. I mean, there's a lot of money that does want to invest in Australia, and super funds or pension funds overseas are big ones. So they're looking at Australia really closely. Sovereign wealth funds are other ones as well. So, there's definitely money that's targeting Australia, and going in and providing funds for someone to, providing debt to someone is easier for some sovereign wealth than trying to buy the property themselves. So, I think so they get the exposure through the debt as opposed to actually owning the property, where they then have to worry about the management and all those other components.
And there's also concerns around sort of foreign investment and other ways in which they can get all the benefits of Australian real estate without some of the government sort of implications of it. And we've spoken a lot about price growth and predictions for growth. Can you give me a sense for valuations within commercial assets? No doubt there's been a lot of write-downs in value of office space. So what most Australian private investors, it doesn't really have too much of an implication for them, but where we're going to see the direction there?
Well, they're going down. So the MSCI index only, that's the one, that does give us the clearest idea as to what's happening across asset classes. And it is showing office and retail both declining. That's based on the listed space only, and it's based on the valuations that have taken place. So industrial has come back, but it's still increasing. So I think this year it'll probably start to improve. I mean, look, it's hard to tell, but it's likely it'll start to improve. I think the economy is starting to get more normal. We're starting to see interest rates, the outlook for interest rates change, so that's certainly changing the outlook as well. So at the moment, not too well, but again, hard to talk about it en masse and say all properties are falling in value, because we know with industrial the diversity is just so great from one location to another and one asset to another. It's difficult.
And you mentioned that's the listed space. Is there any sort of data houses out there covering unlisted properties and the stuff that mums and dads buy? Like, is there anything out there yet that covers that on a mass level?
Yeah, I mean, we do get the transactions, but then the transactions aren't that frequent. So it does make it really hard for us to get a clear idea of what's happening. So Real Capital Analytics is really the best one because it tracks every single transaction. So, you could look at that, but then, it's hard to... It's
still limited.
Yeah, it's still quite limited. So it is difficult to yeah, commercial property values are hard, which is why commercial valuers do need to be so much more, they do need to be so much more specialised because it is such a difficult thing to do.
And give us a sense for rents unconscious of time. Should there be an expectation of increases over and above the new normal where inflation will be?
Not for office. So incentives are really high at the moment. Yeah. So office is not going to really see much rental growth. I think coming back to the construction problems, that's going to continue to increase rents in industrial. That's a clear one. We can also see it in residential. That's also a problem. Lack of housing is leading to rental growth. Retail, again, a little bit hard. I mean, it's not a... I think if you're looking at retail, you're probably looking at development potential. As you mentioned, the investor you were talking about before, what is the redevelopment potential? What's the yield? I mean, not everyone's looking for huge capital growth. They sometimes just want something that yields quite well. So, I think there's other considerations for shopping centres, and location is one, type of centre is one, and then also what you're looking personally for in an investment.
So, summarising this discussion, we're marching towards, I hate the phrase, a new normal with commercial real estate. Once we get inflation behind us and normalised, and an interest rate environment where we'll get some cuts, it'll probably stabilise for a period of time. It's not going to go back to where it was 18 months ago, but that's encouraging. You don't want too many seismic shifts in and around any asset class. Makes investing hard. You've got to time it a lot more, and it's a lot less forgiving. So we're moving into a more forgiving commercial market, Scott.
You say that, there might be a new war or something else pop up.
Who knows?
But yeah, right now it looks like the path is clearer, that's for sure. So hence why the confidence is a bit high on general for, most of these investors we talk to. So yeah, it's I guess the new norm is where the rates will end up stabilising at, because right now they're a little bit too high for the current yields in both resi and commercial. So if that comes down and sits at 1.5% less, then I think that will be a good spot for many investors who are purchasing at the current price.
Mm. And do you like stability as a commercial property investor, or you like a bit of flux?
I'd look a little bit of flux for sure. Like, we plan for it. Like, that's why we look at all asset classes, from childcares to even offices to industrial. Like, again, you're buying for 50 years. It doesn't matter what's happening this year. Like, I couldn't care less, to be honest. Even if rates jumped up another 3%, it would not change my opinion on what we're buying, because it's not going to stay like that for long. So it's all noise. We're buying for the long-term picture. Australia's got an ever-expanding population. There's more wealth being created here. We can almost immigrate our way out of recessions. Like, we're the golden goose of the property world. So that's what I think long term. And yeah, the noise and whatever they say on the news, that's just for giggles here and there.
And for you, Nerida, outside of joining me and Scott on Inside Commercial Property has been one of the highlights of your jobs. Why do you enjoy doing what you do so much?
I guess property. I like property people. I think it's a very diverse crowd. You've got the institutional crowd, you've got the private. So I always get to meet different people, working across sectors as well. Like, the rural agents are quite different. People that own farms are quite different to someone who owns a childcare centre, for example. So I guess that for me does keep it
diversity.
And also people have really strong views as well, and I like that too. That people have strong views. They, there's a lot happening. There's a lot of, like, talking structural change. There's a lot that happens globally that affects property, and it does keep it very interesting. Yeah,
it does. Well, thanks for joining us today, Nerida. It's great to bring you. I'll have to bring you back in as we try and map and give some insights into how commercial and property investors can make more informed decisions. Insights for you are very, very valued, and thanks for spending the time today with us.
Thanks for having me. It was really fun.
Thank you so much.
Nice. And Scott, probably posing more questions for people. So what do they need to do to chat with your mob and work out what they're going to do?
Just email us at info@rethinkinvesting.com.au, and any questions. If you want to discuss your own portfolio, happy to review it, and financing, all that type of stuff. It's all in our wheelhouse, and And next month, we're hopefully going to get another one of my clients on. Very successful lady who's invested many times over the years. So, International Women's Month. So just continuing the theme. And there's it's an underrepresented field. So we really want to get the word out and encourage women to sort of take control of their own finances, especially in this field, because you do have less competition as well. From an investor point of view, everyone looks at residential. It's the default move. But this is why I think the returns are a little bit better here, because you can squeeze out a better asset. There's more risk, and that if you can get around the risk, that's how you can make more money. So
and the point I would make is that you said it's a 3 to 6 month at least cycle to take action. So if you're thinking about it, it's probably best to actually start taking action, because these things do take time.
Yeah, and then you don't have to rush. Take your time, get your finances sorted, and get your budgets lined up. Start looking at assets in those price points. Look at a few. Eventually, you'll land on one that resonates with you, and then bang, you're a commercial owner.
Nice one. That's Inside Commercial Property, Rethink Investing. Thanks for tuning in and joining us online as well. We'll see you again next time. Until then, bye-bye.